Okay, my name is Darren Joseph from HEJ.tax. We're a team that seeks to demystify the sometimes confusing world of cross-border taxation. And today we have the honor and the privilege of joining us, Edward Gordon. Edward, could you please introduce yourself?
Sure. I'm Edward Gordon. I own a company called Preservation Capital Partners. We've been doing tax structure work for over 30 years, both for U.S. domestic and for non-U.S. families and entrepreneurs. Some actors, some athletes, but not a whole lot. Mostly entrepreneurs and wealthy families.
Fantastic. Sorry, finish. Okay, and today we're going to talk about an often misunderstood concept called PPLIs. Please, could you explain to us in layman's terms exactly what is a PPLI?
Sure. So PPLI is nothing more than a cash value life insurance policy. So if I start from the beginning, most people are aware of traditional retail insurance product, so whole life or regular universal life. And in those insurance contracts, somebody puts dollars in, an outlay or premium. The insurance company takes out a pound of flesh for their fee structure, commissions, and so on. And after that, what's left over falls into a bucket called cash value. Right. And cash value is exempt from current taxation, so grows tax-free. It could be borrowed out tax-free. And when the insured dies, the death benefit of the policy is paid tax-free to the beneficiary. So those are really great attributes. In the retail product, the insurance company invests that money in their general account. And we care about the credit ratings of those insurance companies because if the money's invested in the insurance company's general account, it's subject to the insurance company's creditors. So if New York Life or Guardian or Northwestern Mutual went out of business, your cash value is subject to their creditors. And when the money is invested in their general account, typically the insurance companies investing in very conservative investments, bonds, mortgages, fixed income instruments, nothing really overly sexy. It's because they're looking to drive the quality and the stability of their product. There's another product that insurance companies have on the retail side called variable life. In variable life, the cash value is not invested in the general account. The cash value is invested in other assets, for instance, mutual funds or ETFs or other investments that are on the insurance company's platform. Typically overpriced and underperforming, and usually the insurance company owns those investments. So I think Pacific Life owns, whatever. Mutual fund company, New York Life owns Mainstay Funds, and Guardian owns Park Avenue Securities, and so on. Nice, but wealthy people can do things that other people can't. And that brings us to the private placement variable life. And one thing I should bring up before that, because the assets are not held in the general account of the insurance company, and they're held in what's known as segregated accounts, or sometimes known as protected cell accounts, the cash value of a variable life policy is not subject to the creditors of the insurance company. That's pretty incredible when you think about it. So the insurance company is really acting as more of an administrator in a variable life policy. So the insurance company puts together a contract. They may own the risk portion, the death benefit piece, or they may lay that off to Munich Re, Gen Re, or Swiss Re, or one of the reinsurers. And they're not managing the cash value. So they're really just acting as a administrator. Since wealthy people can do things that other people can't, the institutional world came out with a product that was known as variable life. And since the only investors are allowed to invest in it are accredited investors, the government said that you must do this as a private placement. So adopting the word of using, other Wall Street scenarios where they're only available to accredited investors or qualified purchasers. In those environments, we come in two flavors. One, the investments of the insurance policy can go to a list of insurance dedicated funds that are on the insurance company's platform. So just like the retail product without the fee structure, without the, it's the minimum cost structure with sexier investments. So you may be able to buy select investments like Millennium Hedge Fund or Golub Capital or much sexier investments that are on the insurance company's platform. The other model of that is where we spend most of our time, which is called the separate managed account model. When I first started in the business, it was called the asset allocator model. And that's where the insurance company lets you choose a manager, and that manager goes out in the world and can invest the funds of the policy. Now, again, the great advantage of these policies is that cash value grows entirely free of taxation. Done, depending on the design of it, money can be borrowed out of the policy, tax-free. And upon the death of the insured, all of those assets are paid in cash or in kind as death benefit. To use the wrong terminology with the same result, if I have assets in my policy, upon the death of the insured, they're paid to the beneficiary at then current market value tax-free. You and I would say that is a step up in basis. Now, it's not really a step up in basis, it's death benefit under Section 101 of the tax code, but it's the same concept. So if you can get the cost structure down on these policies to be a de minimis level, and you're driving cash value return, you can end up with large amounts of tax-free death benefit, far in excess of what you could buy on a traditional life policy. You'll, in essence, if you think that your investments can beat the way the insurance company would have invested the money, then this is a much better product. And since most people we work with believe that, private equity and credit investments and other investments that are tax inefficient otherwise are better investments inside of these vehicles.
Sorry, that's a nice segue as well, because up until this point, we've kind of been saying cash, but other assets can be folded into this structure, right?
Sure. So let's go over the two rules, because when you boil this down, there's only two rules when it comes to the design of these products. One rule is the diversification testing. And the diversification testing takes place after the first quarter, after the first year. Your policy must meet requirements on the last day of each quarter following the first year. What are those rules? A little confusing. No one asset could be worth more than 55% of the entirety. No two assets combined could be 70%. Three assets, 80, four assets, 90.
Wow, that's very specific.
But there's exceptions. But there's all sorts of exceptions. I'll give you one exception. If one of your assets got really pregnant, swelled in value, you could clearly be out of diversification on market value. But there's an alternative test called the market fluctuation rule. And it says that I can value the assets at their cost basis for diversification. So, for instance, if I put in $5 million into an insurance policy and the asset allocator or the manager, invested $1 million into 5 different assets, 20% each. I clearly meet my diversification. And, some quarter later, we find out that one of these investments really, really swelled in value. We're still diversified because of the market fluctuation rule. Otherwise, you could not have fixed assets inside of these products.
Exactly.
You would be really subject to only assets that the manager could liquidate prior to the end of the quarter to reshuffle the deck. So that's one. Two, another weird exception. If real estate or a real estate entity makes up more than 80% of the value of the contract, you actually have 60 months to meet the diversification test, not 12. Just an odd rule. And again, there's all sorts of weird rules. For instance, U.S. Treasuries or any government guaranteed asset counts as a diversified portfolio by its nature. So it's funny, I was reading, getting really geeky. I had to read something on diversification the other day, and I came across a private letter ruling that said if you had $250,000 in a CD, and the CD was FDIC guaranteed, that $250,000 counts as a diversified portfolio of assets. It meets the exception of a government guaranteed security.
Okay.
So right now we have a lot of money sitting in U.S. Treasuries or U.S. Treasury money market accounts, where the sole investment are U.S. Treasuries. So
interesting. So you mentioned 2 rules. So the first one is the diversification piece. What's the second?
So the diversification test is reported to the insurance company after the last day of each quarter. And just so you know, you don't need to be diversified the day before, only on the day of the last day. So you may have a portfolio that has a high concentration in a liquid in a one position, and then the manager may, the day before the end of the quarter, look to diversify and then go back to it afterwards. So that there's a mark. It's the last day of each calendar.
Good.
Okay. That is something that is seen and reported. And if you screw it up, you potentially can screw up the tax nature of a life insurance contract. The other rule, which is hard to see, but I think is more important because it's where the IRS will really scrutinize these policies. And there's really only one real court case on this rule. And that's the rule of investor control or owner control.
Right. Yeah.
And what it says is that the owner of the insurance policy may not dictate what is specifically bought and sold on a granular, regular basis. So my client can tell me as manager, I want to buy things that are kosher, Sharia compliant, don't hold firearms over some holiday. That's fine. They can't say go buy Apple stock.
Right.
And I don't even think that my client should be able to suggest to me, here are 10 things that would be really good for my policy. You choose which one you want and how much. I think to the letter of the law, that's probably okay. But I think optically, the client's just better off giving an overall philosophy, and we go out and open up an account at Goldman Sachs to manage the equities, and open up an account at somebody else and maybe commodities, and then go out and buy different private equity and subscribe to different deals. That's what we do as a manager. It has an enormous amount of flexibility, but since the rule of investor control is not statutory, it's judicial. A judge can one day decide that it's something different than what we think it is.
Okay.
There was a court case called the case of Jeffrey Weber. If you'd like, I wrote an article with a bunch of lawyers. It's if you have trouble sleeping, it might be a good article to try to read.
Where was it published?
2016, 2017.
2016. Was it in like tax notes, or where was it?
Journal of Taxation.
Journal of Taxation.
I'm sure everybody.
Cool. Yeah.
So Jeffrey Weber had a private placement life policy owned by a grantor trust, which means that he as grantor owned the policy for tax purposes. Important. And Jeffrey Weber had tens of thousands of emails directing his managers to what to buy and sell on a regular basis, and it went on for a very long period of time. And obviously nobody knew about it. Supposedly, let's just say Jeffrey ticked off somebody and they became a whistleblower and sent the IRS a laundry list of things to look at, and this was one of them. And the IRS and the tax court rightfully held that during the existence of the direction of these emails, and the manager, by the way, took 100% of that direction and acted on it in accordance to the direction, that you don't get the tax-free buildup of the insurance policy that you should have, and you owe the taxes you should have paid plus interest. There were no penalties in that case. I could tell you a million reasons why, but I don't know factually. I've worked with the two lawyers that were involved in that case. There's only two people that I know that really were involved in a case of investor control. Everybody else is really a spectator thinking they know what they're talking about. It is a rule where even Senator Grassley had asked the GAO to write a report on private placement life policies and their abuses, and it really came down to the example I gave. It just said this is perfectly fine. The owner may not tell the manager to buy Apple stock. That is actually the example that was given in the GAO report. I've had clients send me pitch decks, and I just call them back and say, I'm sorry, that's not an investment we can make in your contract. I don't care if it was a winning lottery ticket. It's just, it's not just them that I'm worried about. It's my reputational risk. It's the industry. I don't want to ruin this. And it has other real advantages. So in essence, the cash value portion of the insurance policy is an LLC. That LLC has a manager. Bolted to the top of that LLC is a certain amount of death benefit required under the law to call it insurance. And you have an insurance company that bolts it all together and provides the administration and the contract. So Bob's insurance company doesn't manage the assets. Manager does. Bob's insurance company really doesn't reserve for any of the risk because the death benefit piece is bought through Munich Re, Swiss Re, Gen Re, Canada. There's a million reinsurers. And each quarter, Bob calls the manager and says, how much is in the policy? Do you meet diversification? Show it to me. And then Bob writes back and says, here are Bob's fees, what they call an M&E. And here's the cost of the death benefit this quarter that goes to Munich or Gen Re or one of the reinsurers. And the manager wires the money to the insurance company to pay Bob's fee and the reinsurance fee, and then you don't hear from them until next quarter.
So this is quite fascinating. So, obviously somebody listening to this, so many lights are going off. What are generally speaking, we can probably dive into it later on, but generally speaking, what are the purposes or the variety of applications for a structure like this?
There are a lot. One is obviously it provides death benefit to typically a trust and estate planning. Life insurance by nature has asset protection value. 99% of what we do is owned by trust, so that has its own asset protection nature as well. So, but for investing purposes, just like in the retail variable life policy, you'll find, companies have the accumulator 6 and the, whatever. And you're looking this to drive cash value rate of return, which ultimately pushes up the value of death benefit. And you can own assets in there that normally would have been tax inefficient had you held them in your own name or in or what I call a naked trust. The way the trust would have taxation. Here, the insurance policy can invest in those assets, I'll give you, for instance, a credit investment, which is all the rage right now. So we go out, we buy these credit investments, and they produce a 12% coupon return. And if you live in a high tax area, you may be paying up to 50% of that in taxes. Now you have a 6% rate of return when you could buy treasuries at 5%. That's not such a good deal. But if you're in a life insurance structure and the cost of that structure on the high end is, let's say, 1%, so now you're earning 12%, you're paying 1% to the insurance company and the reinsurer, and you're compounding at 11. Well, all of a sudden, that's a game changer. So that might be a good investment for the type of policy you have, although you have to assess risk, right? For U.S. persons, this works really well for exactly those reasons. For non-U.S. persons that normally could be subject to U.S. taxation, whether it's pre-immigration planning or just a non-U.S. taxpayer who wants to invest in certain U.S. asset classes that are subject to U.S. taxation, we use these insurance policies or annuities, which is really just the insurance policy without the death benefit, to hold these portfolios of assets. So I was just in a conference in Guatemala with a number of families most of them were more than 100-year-old family businesses in Latin America. And if you look around the world as to where you want to own assets, there's not a lot of countries where great wealth can hold large amounts of investments. A lot of people do want to invest in the U.S. A lot of people don't want to be subject to U.S. taxation because you could be a U.S. taxpayer without being a citizen. And so this is a neat way to hold assets so they're not subject to U.S. tax, especially for somebody who may have their children that go to college here, fall in love with somebody and live here, and maybe they're going to inherit non-U.S. they're going to inherit assets from the non-U.S. parent. These are ways of holding assets in policies, in trust, to make those transactions far more efficient from a tax perspective.
So I'm thinking in terms of just general estate planning, wealth management, retirement planning, charitable giving, pre-immigration planning, probably into and out of the US, depending on what you're trying to do and what your circumstances are. And something else popped into my head. I mean, that's the obvious stuff, but something else popped into my head. I'm going to run it past you. We know that I think by the end of 2025, all the benefits from President Trump's Tax Cut and Jobs Act, they would expire. And, the lifetime exemption, which is, I don't know, somewhere between 12 and 13 million, would go down to, I don't know, maybe 5 million, but a lot less than that. Is this an opportunity? I mean, we don't know what's going to happen. Anything can happen, but let's assume it expires. Is this a strategic opportunity to gift assets into the structure?
Absolutely.
Yeah.
Absolutely. We've had this several times in my 30 years where the threat of that exemption amount dropping. So we had lots of clients do things like, even temporarily, like lend money to the trust, and the day before, if the exemption amount doesn't change, then at that point, they forgive the loan, making a gift. And if it doesn't drop, then, well, they make the gift, but either way, it gives them the flexibility of either pulling the money back or leaving it there. But I look at this product as just an insulating layer around the portfolio of assets to make taxation more efficiently. And for the vast majority of our clients, this is a pocket of money that's never going to be touched. So it really just becomes, at the end of the day, death benefit, which is paid tax-free, which can be used to pay estate taxes, all sorts of other things. It just makes things more efficient. And then I have other clients that utilize this just to, I'll give you a prime example. Large family has great wealth. They have a significant amount of money sitting in a grantor trust, and grandpa's paying the taxes on all of this investment return that creates taxable noise. And that's a nice idea, because grandpa paying the taxes on his grandchildren's trust is not a gift. But I would much rather see grandpa give all that money away he's paying in taxes to charity, if he so desires to give it away, then give it to the government. So by going to the trustee and having the trustee acquire a private placement variable life policy, we put all those assets into the policy as a premium, and on an ongoing basis now, there's no taxation. But grandpa's not depleting his estate by the taxes being paid on the family trust. He could choose to keep the money, give it away, or live like a rock star. And then let's assume grandpa or grandma was the insured. When they pass, all of the assets of the trust get a step up in basis, quote unquote. It's death benefit under 101 of the code. There's no other place in the tax code where an asset held outside of a taxable estate, it's a reset in its basis, the way we could do this with life insurance. Now, that death benefit could be used as traditional death benefit to pay estate taxes. It could be done just to hold assets. There's a million different things, but you're creating a far greater efficient transaction by doing this. And there's so many uses.
All right. So, I mean, clearly it could be a silver bullet. I mean, it would address so many use cases, but could you speak to what it's not good for?
It's not for a client who's an egomaniacal, narcissistic sociopath that has to control every aspect of what's going on. Because I will tell you, Senator Wyden is looking once again into private placement insurance being a area where wealthy people are using this as a device to avoid taxes. I don't think there's anything they could do about it. It's just life insurance. It's just regular variable life made for accredited investors. So it's just institutionally priced and with more flexible investments than the retail product. I don't know where, it's the same section of the code. It's not like it's not like PPLI is a different section of the code. So I would avoid an overt exercise of discretion over what those investments are. I think that's really the pinch in the hourglass. So who your client is and their disposition, it may not be for everybody. I don't think this is for investments that are going to earn less than a 5% rate of return. I think that, and I don't think it's really for investments that are tax efficient. So you're not going to buy municipal bonds and hold them to maturity inside of a policy. You're paying a fee for the cost of death benefit and the insurance company's fee. And if you're not offsetting taxes for that, I don't know if it's worth doing.
Right. And so, okay, so we know it works obviously in the US, and therefore chances are it's working in other common law jurisdictions. But what about civil law jurisdictions? Because you mentioned you do a lot of work in Latin America. Are those jurisdictions okay with it?
Some. So it really depends.
Right.
And it changes. So I haven't done anything in Argentina, but my understanding is that somebody from Argentina is an Argentinian or Argentine. I never got that right. I believe that they have a law that says they can't buy an insurance contract that's not issued by a company out of Argentina.
Argentina, right.
And again, at one point I paid a lawyer to put together a grid for me from most countries as to what, can you do this? What are the rules? How to do this? It is ever changing. So I know in Uruguay you can, because I've done it. Spain, far more problematic. Spain does not recognize trust, and they do not recognize the cash value of insurance being not subject to Spanish taxes. So there's a lawyer that I utilize at Baker McKenzie, a couple of lawyers that I use at Withers. These are big global tax firms. There's others. And they're kind of my go-to people because they're more up on it than I am. I couldn't possibly be up on every country, but the Philippines, Hong Kong, Australia, easy. They all have a certain recognition of insurance, and the U.S. typically has a treaty with them that, if, for instance, if you have a Bermuda insurance policy, Bermuda has a treaty with the U.S. that says if you have an insurance policy that's under Section 77 of the U.S. Code and 817H, we'll recognize it as a life insurance policy for all U.S. tax and compliance purposes.
So, right. So you need to pay attention to the jurisdictions that are impacted, where the beneficiary is going to be exposed, where is the grantor, the person who contributes to the policy, where do they sit, which jurisdictions do they touch? It could be nuanced.
And you might even have to have a special type of policy. So you may need to have a EU and US compliant life policy. So you may have a what we call a dual compliant policy, and that really just means how much death benefit is needed. Usually, the U.S. requires more than most. That's just plumbing. But the real, when we do planning, we look at the situation. What's the tax residency of the grantor? What's the tax residency of the trust? What's the tax residency of the beneficiaries? What are the rules? How do we do this? And I'm the first person to tell somebody no.
Right, gotcha. All right, so let's look at the advantages are clearly obvious. Tax efficiency, we don't need to talk about that, but the asset protection as well, because once it's locked in, no one, the creditor would find it quite hard to access it. And then the whole, providing for that next generation, that estate planning, it seems so comprehensive. But of course, as you pointed out, the limitation is the control. So how does it stack up, let's say, to trusts and foundations? Is that a conversation you have with clients? Like, do they say, okay, well, I know there's a PPLI, but compare that to a trust if it's a common law jurisdiction, or if you're dealing with someone in Latin America, how does it stand against a foundation? Is that something you have to discuss with them?
I don't really get into the foundation conversation much. We really talk about, well, if you just do the trust, again, I call it trust without PPLI in it, a naked trust. The question is what would be the advantage of, instead of the assets being in the naked trust, that the trustee, it lines the trust with this insurance contract? What are the advantages of doing that? What's the cost, and what's the cost to that? Typically, there's an enormous advantage because it creates another layer of protection for asset protection purposes. It also creates another layer for taxation purposes. And again, you'd be hard pressed to find cases where the insurance policy wasn't respected. There are some abusive situations out there. There's a very large case where a Swiss firm was taking monies that were never declared as U.S. taxable investments, where the U.S. taxpayers were literally shifting them overseas not to pay taxes. And someone had the bright idea of saying, well, instead of declaring them, shove them all into life insurance and have it paid as a death benefit tax-free back to the U.S. Well, someone blew the whistle on that, and the insurance company ended up paying an enormous fine. But that really had nothing to do with the insurance contract. It had to do with, hiding U.S. taxpayers' money that should have been taxed and declared, and trying to figure out a way of getting it back tax-free. The policy still worked. It's the plan. And look, there's a lot of bad actors out there, and we see them a lot. We really do.
Okay. So in terms of, I guess that's a nice, again, a nice segue into the risk. The risks are, as you said, if somebody is that egomaniacal, want to be controlled, and it just simply won't work. But then you also mentioned 1%, so there's a cost, right? There's a cost to setting up and running this structure. Could you talk to that? And you also mentioned the risk, depending on what jurisdictions, beneficiaries, or whatever exposed to. It could be tax transparent and it may be taxable, but that could be managed using the right legal professionals in the jurisdictions and stuff like that. But I guess the one thing that seems to be difficult to mitigate is the cost of operating the structure. Can you comment on that?
Yeah. So in essence, there's 3 fees in the insurance policy. So, well, let's start here. There's fees to set it up on the legal end. There may be some valuation. There's some gifting. There's what I call outside the policy plumbing. So there's professional fees that are done typically. But the policy itself has 3 components to it. The 3 components are the insurance company's M&E, management and expense. There's the cost of the death benefit, which goes out to Munich Re, Swiss Re, Gen Re. And then there's a fee that goes to is attributable to the investments. I don't really count the fee that it's attributable to investments as a real fee because the client would have had those fees had the policy not existed. Right? I mean, still, if you had money over at a hedge fund, they're going to charge you 2 and 20 maybe. Well, they're going to charge the policy 2 and 20. So it's so let's just talk about the 2 fees that are in the insurance policy: the insurance company's M&E and the death benefit cost that goes to the reinsurer. Those fees, depending on how you design it, can range anywhere between 60 to 115 basis points. So between a little more than 0.5% upwards to over 1%. And there's a reason for the range. One is the design. So you can design an insurance policy that may be really efficient from a cost perspective, but inefficient from maybe your ability to access your cash value. You may make it slightly more efficient from a cost perspective, but if you borrow money out of the policy, it won't be tax-free, it'll be taxable. So for the client who says, I'll never borrow my money, I have one design. From the client who says, well, I don't really have a need to borrow it, but I want to be able to borrow it. Well, you'll pay an ordinary income tax on your borrowing, but the cost of the contract will be cheaper. And then the client who says, no, I want full rights to my cash value, and I don't want to pay tax on my borrowing. That's the third regime. And then there's also different designs that we get involved in. I've done group insurance policies where my client's not the insured. We insure thousands of people's lives and we own the cash value. So if you think of, I'm from New York, so we think about everything in the form of pizza. The sauce and the cheese is your cash value. And the death benefit piece is the crust. And when an employee dies, you get back 1/1000th of your cash value tax-free. And the employee or the company gets their piece of the crust that you paid for. Those policies are more expensive. However, I could deploy far more money into these policies than I could on a single life and still have it compliant with able to borrow my money tax-free. So one of the other cost structures that, against my own interest, we do and we mandate, there's 2 things. One is we only work with insurance companies that will guarantee their cost structure, meaning that it is scheduled in the contract and cannot be changed.
No bait and switch.
I don't need to see some fine print that says at any time the insurance company has the sole discretion to change the M&E fee. It's not going to go down. I assure you it's not going to go down. And it's nothing more than the frog in the boiling water, where they keep on creeping that up until the guy, he doesn't realize that he's boiling to death. So we're sticklers about that. The second thing is on the contracts that we work with clients on, when monies are borrowed out of the insurance contract, the insurance company's M&E fee goes to 0, the borrowed monies. And that's the larger part of the fee structure.
Mhm.
So I'm going to make up numbers.
Mhm.
Let's say the insurance company is charging 60 basis points for M&E, and the cost of the death benefit is another 25 basis points. So 80. So that year the cost was 85 basis points. If the client borrowed money out, the 60 basis point piece goes to zero.
Mhm.
That makes it a far more efficient vehicle to do with what the client expects to do with it.
Mhm.
I like that, because the last thing you want to have happen is that the fees in the contract are so high
Mhm.
that when you borrowed money out, you may jeopardize the policy lapsing.
Mhm.
And if you have a lapse on a policy with a loan,
Mhm.
you might have a very large taxable event. So by
So,
so when they borrow money out of the contract and you can keep the cost structure really low, you have a much, much better chance of the policy never lapsing, because whatever's left in the policy will be able to generate enough money to keep it in
the
force.
cover of it. Right.
Yeah.
Okay.
Yeah.
So you mentioned, so I'm wondering, of course, completely anonymize it, but then if you could speak to some experiences that you may have had in dealing with other jurisdictions. So I know you mentioned Latin America. Have you had any experience structuring policies for clients who are exposed to Europe, or no?
Yeah, I mean, and Europe's tough. Not every country in
Yeah.
Europe has the same rules. I mean, as I said, Spain is difficult.
It's a
England is
no-go.
England is not that easy. Go ahead, I'm
England's not
sorry.
that easy. Okay. So could you talk about how it works with US, UK? Just generally speaking, things
So
to look for.
we were going to do a policy with a UK
Mhm.
taxpayer, and we were going to have the policy deployed into US private equity, and it was just
Mhm.
a lot of questions as to whether the return on the private equity investments would be exempt from British taxes.
Yeah.
And we chose not to do it.
Right. Okay. So it didn't work. Is there any jurisdiction where it did work in
Sure.
Europe?
I mean,
Yeah.
Switzerland is
Okay. Right.
easy.
Mhm.
I mean, and they're the providers of a lot of these policies. So
Mhm.
Italy, Luxembourg, Israel,
Mhm.
we have a lot of Israeli taxpayers
Mhm.
who like investing in U.S. real estate.
Mhm.
And the way they had been doing it before was they were coming in as debt. So they weren't subject to U.S. tax, because if they bought U.S. real estate, they're subject to U.S. taxation. So we make
Yeah.
those investments through the PPLI policy.
Mhm.
However,
Mhm.
on death,
Mhm.
borrowing, or surrender, if the beneficiary is an Israeli beneficiary,
It's gonna be, yeah.
there's a 25% tax on the gain
Mhm.
at the Israeli level.
On the Israeli side,
But
the US
but
is
it
fine.
works. It works for U.S.
Mhm.
But in that case, we've had clients that were residents of the UAE,
Mhm.
and
Oh, there's nothing there.
there's
Yeah.
nothing there. So we actually
Yeah.
don't use a life policy there. There we use,
Mhm.
in most cases, use an annuity.
Mhm.
And because the annuity just it's the same product, except it doesn't have the death benefit component. So it's one less fee, even though it's de
Mhm.
minimis.
Right.
And when they surrender the annuity, they don't pay taxes in the UAE.
Yeah. Well, there are no taxes, generally speaking, in UAE. But I guess if they were, that's assuming that they're not exposed to any other jurisdiction. Because if
Correct.
they were US exposed, then you're back where you started, right? Yeah.
Yeah. So
Yeah.
again, every one of these countries is
Mhm.
case by case. At one point, we did this for a number of Chinese nationals. And
Mhm.
I think the last time we spoke, I think I told you that I kind of abandoned that a little bit, because I found that it became far more difficult for Chinese nationals to actually get money out of China.
Right. Yeah.
So
Yeah.
so the
That's
money
a
that was
challenge.
already out,
Mhm.
was already
Mhm.
easy to work with, but
Yeah. Mhm.
you know,
Mm.
you have to
What
be
about other parts of Asia, like Hong Kong or Japan, or no?
Hong Kong. This is huge in Hong Kong,
Yeah.
Taiwan, Singapore.
Yeah.
Um, as I said, Australia. I haven't worked with other jurisdictions, but I'll give you, for instance, it works very well in Brazil.
Okay. So let's talk about Brazil. How does it
Huge
typically?
country, right? Lots of wealthy
Yeah.
people.
Absolutely. Yeah.
I
So,
actually have a presentation in
yeah.
Portuguese someplace.
Oh, wow. So from a Brazilian point of view, because obviously we know it works for the US, right? But from a Brazilian tax point of view, it works as well.
Yeah. As we speak, yes. Can they change the rules? Yes.
Yeah.
I mean, certain countries have changed the rules over time. I think I said that early. Mexico years ago worked really well, and now you got to go through some hoops, and you can't have a Mexican beneficiary. I mean, there's lots of, again, each country. When we go there and say, here's the situation, I then pick up the phone. I'll call you. I'll call the guys over at Withers. I'll call the guys over at Baker and say, and I'll call everybody and say, how would you do this?
Yeah.
And if I don't get a consensus on how to do it, nobody wants to be made famous.
Oh yeah, that's for sure.
But let me give you one other aspect of PPLI.
Yeah.
Most policies are written in Switzerland, Luxembourg, Cayman, Bermuda. It's just jurisdictions that make it more efficient to do these.
From the reinsurance perspective, yeah.
Well, reinsurance or just cost. If you do a PPLI in the U.S., you might have state premium tax. You have some other issues.
I see.
If I was to own a PPLI company, let's say in the States, I might have to put up $10,000 or $20,000 or $50,000 per policy in reserves, even though I may not hold any risk. But if I did this in one of the islands, maybe I just put up a letter of credit of $250,000 and I can write as much business as I want because 100% of the risk is reinsured. Makes it more efficient. If you buy a policy in the U.S. or in a U.S. territory, like Puerto Rico, a non-U.S. person does not have to worry about Common Reporting Standards, CRS. So the U.S. currently does not report to somebody's home country about an account in the U.S. If that foreign person invested in a U.S. in a PPLI contract in Bermuda, Bermuda will report to the home country, or Europe, to that home country that this account exists. One, that lends itself maybe to people that I don't want to do business with that are just purposely doing this to avoid CRS. But there is a real use for it because if you've been to, especially a lot of Central American countries, you don't want people to know how wealthy you are, and you don't want your government to know what accounts you have. And it's more of a privacy issue and a security issue than it is trying to hide, bad money. But there's a lot of background checks that get done both in my office, the insurance company, and the reinsurer before we get the green light to go ahead.
Do you deal with PEPs or politically exposed persons? Generally speaking,
we have, but in just in the U.S. I have not dealt with any.
Not outside. Okay.
No.
All right. And as you mentioned that, there are a lot of, bad actors in the ecosystem, as there is in any ecosystem. How would you advise clients to go about selecting the right professional to deal with? Like, what do you look for?
You look for somebody who has experience. And my dad would always say that experience is best described as great sailors aren't made in calm seas. When you do something long enough, you see all of the avenues of disaster. I mean, we've had situations where we've had explosive growth in contracts where we, had to figure out how to get more death benefit when it wasn't available. Because you remember, for every dollar you have of cash value, you need a certain amount of death benefit based on age. It goes down every year, but for instance, at age 75, you only need 5% more death benefit than cash value. Well, on $100 million, I could easily get $5 million of death benefit. But if you're 41 years old and you had $100 million in there, I may need $200 million of death benefit. They may cost the same, but I may not be able to get that in the marketplace. So if my insurance contract explodes in value for my 45-year-old client because some of the investments, did 10x, that's problematic. How do you deal with that? We've dealt with that over the years. I don't think there's many situations we haven't seen. That's what you want to look for. You want to, look, you're going to have surgery. I want the guy who's done this every day for 30 years,
with no problems.
and is not much fun. He or she's maybe not be fun at a party, but they
Yeah.
really understand the granular part of it, not just the buzzwords.
Absolutely. And if someone wanted to reach out and work with you and your team, what's the best way to do that? What's the best way to find you?
Preservation Capital Partners. My email is egordon@prescap LLC. We could provide that to anybody. And I'll talk and discuss with anybody on how to do this and where to do this. I won't give away some of the secret sauce we have on making some of these policies more efficient, but it's a good business. It's been around a very long time.
Yeah.
One thing we didn't discuss, every major bank and corporation in America uses products like this to hold their treasury assets in the form of a corporation. So, by example, I don't know if this is true, but Walmart is sitting on a lot of money in their treasury. They insure all of their employees on group life insurance policies, shove all those treasury assets in this premium, hire someone to go manage those assets. And now that treasury assets are growing free of tax, we call that COLI, corporate-owned life insurance. Banks have BOLI, bank-owned life insurance. So banks may take their non-loanable reserves, insure, Bob in accounting and Hannah in accounts payable and all these executives where the bank is the owner and beneficiary of a policy.
Yeah.
And you could actually do a Google search of the term BOLI, put a bank's name in it, and you might be able to find out how much cash value they hold on their books on current and former employees' lives. And I think the number will blow people away. It's another end of the business. And they could use either traditional policies or variable life.
Right. So the point is that this stuff is tried and tested and no issues. That's I think
as long as you don't violate the investor control doctrine and you don't violate the diversification rules, you're pretty much good to go. This is just variable life.
Gotcha. Edward, thank you so much for sharing some of your time, your expertise. And deeply appreciated. And we'll see you next time.
Thank you for having me.
All right. So I'm just going to switch everything off.